There is a number being whispered across trading desks right now, and if you don't have it on your screen, you are about to get run over by an Australian dollar move that is already accelerating. Right now the pair is at 70.07, and it is not just drifting lower, it is breaking structure with an ADX of 47. That is not a suggestion. That is a trend that punishes hesitation. But here is the trap. While half the market is trying to pick a bottom because of oversold readings, the other half is piling into shorts, and both sides are about to collide in a liquidity grab around 70 cents that will shake out one side violently. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow, including the sniper entry that only triggers if the market does something very specific and very predictable. Write this down. The session bias is a relentless intraday fade. Every bounce in the last 3 sessions has been sold, and the 1-hour and 5-hour trends are both screaming strong sell. This is not a range. This is a trending flush lower, and the only thing that flips the bias back to neutral or bullish is a 4-hour close above 70.46. That is the pivot. That is the invalidation level. If we close above 70.46 on any 4-hour candle, the entire bearish structure gets reset, and suddenly the weekly neutral trend opens the door for a snapback to 71 cents. But until that happens, the path of least resistance is down towards 69.85 and then 69.51. The herd is positioned wrong-footed. I'm seeing retail sentiment leaning long, trying to fade this drop, while institutional flow data is showing steady selling into any pop above 70.15. That divergence is jet fuel for a liquidation cascade if 70 cents gives way. So write down 70.46. That is the line in the sand. If that breaks, you do not want to be short anymore. Now let's walk the charts because this is where the hidden alignment makes the trade obvious. Pull up your weekly. The 200-week moving average is way down at 68.37, and price is still comfortably above it, so the long-term structure is intact. Monthly trend is a strong buy. That's what keeps the bulls dreaming. But look closer. The weekly trend has flattened to neutral. That means the momentum that carried Australian dollar to US dollar from 65 cents up to 71.33 earlier this year is completely exhausted. On the daily chart, the picture is brutal. We are in a strong sell. Price is below every major moving average I care about, the 5-day, the 10-day, the 20-day, and the 50-day, all of them sloping lower and clustered in a tight resistance band between 70.05 and 71.34. The 10-day moving average at 70.1090 is acting like a ceiling that price hasn't touched in days. And here's what most traders miss. The MACD on the daily is negative at minus 0.002. But the histogram bars are still widening to the downside. That means momentum is accelerating, not decelerating. That's not a divergence. That's a trend that still has fuel, now dropped down to the 4-hour. The 200-period MA on the 4-hour is at 70.080, and price is trading well below it, which means even the medium-term momentum is bearish. The 20 and 60 MAs on the 4-hour are crossed bearish and widening. The MACD on the 4-hour is deep in negative territory, and I'm seeing no bullish divergence whatsoever, just lower lows in price matched by lower lows in the oscillator. That tells me buyers are exhausted at every level. On the 60-minute, the moving averages are in perfect bearish alignment, the 20 below the 60 below the 200, and every pop toward the 20 MA at 70.0540 has been sold instantly. That is a trend day structure, and it will remain a trend day structure as long as price stays below the 60-minute 20 MA, which is currently at 70.0540 and dropping fast. The key support today is 70.0113, which we are already testing as I speak. Below that, the next significant demand zone is 69.85, which is the S2 level, followed by 69.51. On the upside, resistance starts at 70.074, then 70.1070, and the pivot at 70.046. Those are your lines. The RSI on the daily is at 34 and falling, but it's not yet at the oversold extreme that typically triggers a mean reversion. The stochastic is at 30, curling but not crossed, and the Williams %R is maxed out at -100, which does suggest an intraday bounce could be near. That's the trap. That oversold reading on the Williams will tempt early bottom pickers, but the ADX at 47 says the trend is strong enough to stay oversold for sessions. This is classic. The momentum traders are short, the counter-trend traders are getting run over, and the smart money is waiting for a clear reversal signal that hasn't come yet. But here's what makes this move more than just technicals. Cross-asset linkage is screaming risk off through the China proxy. The Australian dollar is the world's most liquid proxy for China demand and global risk appetite. And right now the signals are aligned. Iron ore futures sold off again overnight, copper is heavy, and the Shanghai Composite is struggling to hold key levels. When Chinese equity markets catch a bid, Australian dollar to US dollar rallies. When they roll over, the Aussie gets slammed. Yesterday's Australian consumer sentiment data showed a slide in June. Cost of living pressure is biting households, and that feeds directly into RBA rate expectations. If the consumer is retrenching, the central bank has less room to stay hawkish, and that yield differential against the dollar starts to narrow. That is fundamentally bearish for this pair over the next 1 to 2 weeks unless the data flow changes, and the news flow in the last 24 hours confirms it. The Westpac Consumer Sentiment Index slipped, with households citing persistent cost of living pressure. That is a domestic headwind that combines with the external drag from China uncertainty. Meanwhile, the analyst community is laser-focused on risk appetite as the driver, but the same note says NAB may yet move the Aussie. That's the wild card. NAB business confidence and business conditions numbers are on deck, and if they surprise to the downside, the rate cut narrative for the RBA firms up, and this pair breaks 69.85 within hours. If they surprise to the upside, we could see a violent short covering rally back above 70.46. So the directional lean for the next 2 weeks is bearish unless NAB and China data pivot hard. The invalidation is a daily close above 71.07. If we close above that, the bearish thesis is dead. Do you think the dollar breaks 105 this week? Comment yes or no. I'm tracking consensus on the DXY because it's the shadow driver of this pair. Now, most people skip this section. That's exactly where the money is made. Keep watching. I'm about to give you 3 trade plans, conservative, active, and aggressive, with exact levels, stops, and risk-reward ratios that you can put straight onto your platform. The first is the sniper, A. Conservative short on a pullback. You don't chase the price here at 70.07. You wait for a correction back into the pivot zone. Trigger is a 1-hour close above 70.0150 but then a rejection back below 70.046. That means price pops to shake out weak shorts, fails at the pivot, and rolls over. The entry is a market sell when a 1-hour candle closes back below 70.046 after that fakeout. Stop loss goes above the swing high of the rejection, which I'm placing at 70.075, just above a 1. That's logical because if price closes above 70.075, it has taken out the first resistance and likely aims for the 10-day moving average. Your first take profit is 70.0130, just above the initial support that we are flirting with now. That gives you a clean 31 pips of downside. The second take profit is 69.85, the S2 level, for a total move of 61 pips. Risk is 29 pips to the stop, making the risk reward on this sniper entry 1 to 2.1. Invalidation. Void the setup if a 4-hour candle closes above 71.07, because that breaks the daily resistance structure entirely. The sniper, so-and-so entry, 0.7046 on 1H close below after rejection stop loss, 0.7075 take profit 1, 0.7013 take profit 2, 0.6985 risk. Reward, 1:2.1 are invalidation. Void if daily close above 0.7107. Now the active trader plan. This is for those who see the momentum and want to ride the breakdown without waiting for a pullback. The entry is aggressive on a retest of broken support. Right now price has slipped below 70.0113. That level, which was S1, now becomes resistance. You set a sell limit order at 70.0150, giving a few pips of buffer above that broken floor, anticipating that any small bounce gets capped by sellers. The stop loss goes at 70.0410, just above the intraday pivot, which gives room but stays inside the bearish structure. If price gets back above the pivot and holds, the momentum has shifted and you want out. Take profit 1 is 69.90, just 2 pips above S2, and take profit 2 is 69.51, the S3 level. That's a 60 pip first target and a 99 pip second target, risking 36 pips to the stop. That risk-reward structure is 1 to 1.7 on the first leg, and 1 to 2.7 if both targets hit. The trailing stop rule is simple. Once take profit 1 gets hit, move your stop to entry, lock in a risk-free trade, and let the second target run. This trade voids if a 1-hour candle closes above 70.46. That's the invalidation. Type your Australian dollar to US dollar range for tomorrow in the comments now. Let's see who's aligned. I want to see if you're thinking 69.50 to 70.50, or if you think we bounced the active trader, AUD entry, 0.7015 limit sell stop loss, 0.7041 take profit 1, 0.6990 take profit 2, 0.6951 risk, reward, 1:2. 7 R invalidation, void if 1H close above 0.7046 now the aggressor. This one is for those who can handle heat and are willing to bet that the extreme oversold Williams %R and the approach of S2 at 69.85 sparks a violent countertrend bounce. This is a high-risk long. Entry is at 69.85 on a limit by order. You're stepping in front of a freight train, so you need a razor-tight stop at 69.72, 13 pips below entry, just under the recent swing low and below S2. This stop is intentionally small because if 69.85 doesn't hold, the next stop is 69.50, and you do not want to be in the way. Take profit 1 is 70.040, right near the pivot, for a 55 pip gain. Take profit 2 is 70.070, below R1, for an 85 pip gain. That's a risk reward of 1 to 4.2, so the math allows you to be wrong several times and still come out ahead if you catch one. Explicit warning. This is only for traders who can lose small and manage risk aggressively. If a 15-minute candle closes below 69.80 with volume, exit immediately. You do not hold and hope the aggressor, high risk entry, 0.6985 limit buy stop loss, 0.6972 take profit 1, 0.7040 take profit 2, 0.7070 risk, reward, 1:4.2 R invalidation, void if 15-minute close below 0.6980 risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news like the NAB release or US CPI. Surprises. Stops are non-negotiable. Every plan I've given you has a hard invalidation. This is how you survive to trade the next big move. The market will still be here tomorrow. Make sure your account is $2. Here is the single most critical level for the next session. Watch 70.046. If price stays below there, the bearish momentum continues and 69.85 is a magnet. If price reclaims 70.046 with conviction on the 4-hour close, the bears lose control and you must be ready for a sharp squeeze back towards 70.1070. Tomorrow's wildcard is the NAB business confidence print, plus any headlines out of China that could flip risk sentiment in an instant. That will be the focus for our next video. I'll break down whether the China proxy trade is about to reprice the entire Aussie complex. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen and keep the analysis flowing. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.